tasked to introduce Mr. Bipin Pawar, a partner with PwC. He has over 15 years experience on diverse matters such as investment and transaction structuring, optimizing benefits under income tax laws and treaties, addressing regulatory issues and tax compliances. Since introduction of the transfer pricing regulations, Mr. Pawar has been advising clients on innovative TP opportunities and strategies, combining industry insight with technical skills to provide holistic solutions from commercial, tax and regulatory perspective. His experience includes strategizing and implementing supply chain structures to optimize global effective tax rates, IP migration, developing local and global compliance documentation, evaluating P issues, developing defense strategies for transfer pricing audits, integrating indirect tax positions and harmonizing transfer pricing and custom documentation. His clients includes companies in the sectors such as pharma, medical, chemicals, electronics, FMCG, logistics and telecom industries. He is a Bachelor of Commerce and also a member of ICAI, and he is regularly contributing to ICAI chambers and Bombay Chartered Accountants Society. So we have a very learned speaker here, and he is going to talk to us on the recent developments in transfer pricing, especially on BEPS, business base erosion and profit shifting. So that is something which is gaining a lot of relevance in today's scenario. So with this, I present before you Mr. Pawar. Before we request you to make the presentation, may I request Yatin Bhai, our President, to present a momentum.
Good afternoon, friends. The subject of my presentation is actually threefold. I'm going to cover some recent developments. I'll try to cover BEPS, but BEPS as a topic is a very large topic. So there are 15 work streams, and to be able to cover BEPS in a 1-hour session and to cover all the 15 work streams is not going to be feasible. So I'll try to give you a flavor of what BEPS is all about, what are the themes over there, and then within that I will spend more time on the transfer pricing work streams within BEPS. So there are 3 work streams within BEPS which focus on transfer pricing. So we will cover those. And then the last part of my presentation is going to deal with the interplay between GAR and transfer pricing. Objective here is not to give a theory on GAR, because I'm sure much has been said and written about GAR, but we'll focus on how does it really interplay with transfer pricing, and that's going to be the theme of that discussion. When I was thinking about what I should present on recent developments, a lot of thoughts came to my mind that the subject has evolved so much, and there are so many developments to cover. So I really had a hard time to figure out what I should talk about. And so I thought that the best way to do it is to put it on a timeline and then cover at least the key developments which are relevant to India. Actually, there are more developments here, but I have not tried to cover all of them, but trying to cover the key ones from an India perspective. September 2012, going back in time, the India's APA program was issued, and everybody in India, all the consultants and most taxpayers in India were looking at this very closely. The government also was important to put up, for them also it was important to launch this program because they wanted to give an impression to the outside world that we as a nation are not a banana republic, and there is sanctity at the end of things. So somewhere there was an effort on the part of the government to launch this program to sort of mitigate the adverse reactions that were coming from the industry against what was happening on Vodafone and stuff like that. Transfer pricing adjustments at that time were again, very huge adjustments were happening. So again, there was an effort to launch this program to quell the hot reactions that were coming on the transfer pricing side. So financial year 13-14 was the first year of this program, and taxpayers who wanted to opt for an APA, they were required to file in their applications latest by March 31, 2013. In the first year of the program, 146 applications have been received and 5 APAs have just been signed. They took about a year to sign 5 APAs. Our program is very much along international best practices. So for those of you who have not looked at the APA program, we have a dual stage. There is a pre-filing stage which is mandatory. The idea of the pre-filing request is that the tax authorities will give you a broad direction. It's not binding and a conclusive meeting, so they will not tell you whether they will give you the APA or they will not give you the APA. But they will guide you that in the facts of your transaction, is that a good case for an APA? And sometimes that direction is enough for a taxpayer to take a decision. The pre-filing request can be anonymous. There is no obligation on you to disclose the name of your company. And they don't even charge any filing fees for a pre-filing discussion. And then followed by pre-filing, the main application is required to be submitted. Main application has significant data requirements, and you should actually budget no less than 2 months to 3 months to prepare that main application, because it actually takes that much time to prepare it. So that's about the APA program. The response of the APA authorities has been very, very constructive. So I'm told that in the second year's cycle, the number of APA applications that they received has actually crossed 250, which essentially means that in 2 years' time we are looking at 400 applications. And I doubt anywhere in the world, even in advanced nations like the US or the UK, you will not find these kind of numbers. So that's an indication of the fact that the program is actually going very well. In January 2013, we had the special bench ruling in the case of LG Electronics on marketing intangibles. What that ruling essentially said in the facts of LG, and LG's facts were that they were a licensed manufacturer for the Indian market. They were paying royalty to the Korean parent. They were importing raw materials and components, and then they were manufacturing home appliances. The critical point to note was that both the royalty payment and the raw materials that they were buying, LG had independently tested them to be arm's length, and therefore after making those arm's length payments for royalty and for import of components, the residual profit that remained entirely remained in India. The special bench took a view here that LG was spending on advertising and marketing for the domestic market, and they took a view that LG's advertising and marketing spend was significantly larger than spends of the comparable companies, measured in terms of advertising to sales ratio. And they said that this difference constitutes excess AMP spend. That AMP spend confers a benefit to the parent company because it strengthens the brand of the foreign company, and therefore it's a service which needs to be compensated. So that was the crux of the LG issue. With due respect to the special bench, the principle that they've held is completely incorrect, as any transfer pricing professional will tell you. Because if the question here is that before you even decide that is there really a benefit that is being conferred to the foreign party because of AMP spend, the question that has to be asked is that when an Indian company spends on advertising, who is it really spending on advertising for? And in what form and manner has a benefit been conferred to the foreign party? So here the facts of the case were that the foreign company did not have any direct sales into India. Okay. The facts of the case were that LG was paying royalty, and that royalty was independently tested to be arm's length. LG was also paying for raw materials and components, which was also independently tested for arm's length. And therefore, after having made those payments, whatever remained, the Indian company was retaining in its books of accounts. So it took the risk of investing in the domestic market, and it kept the full reward. In what form and manner is the foreign company really benefited? So here, the convoluted thing that they came up with was that to judge whether a benefit exists, they looked at the comparables, and they found that LG was spending too much money. And they said that this excess money which was being spent on advertising and marketing constituted the benefit. Now, in reality, that's not how it ever happens. If you analyze license agreements anywhere in the world, you will find that licensees everywhere in the world are expected to spend on advertising and marketing to develop the market, and that's how they make money. You will never find a situation where the licensor says to the licensee that you spend the money and I'll compensate you even more. It never happens anywhere like that. So be as it may, this ruling now exists, and TPOs around the country are applying this ruling on a day-to-day basis. And you know, there are a few cases that have now reached the High Court stage. I think in the case of Canon India, Casio, I think you know, the Delhi High Court has admitted questions of law on this. So we will have to wait and see what the outcome of this is. I'm quite hopeful that this ruling somewhere in the future will probably get reversed. February 13, OECD issued its initial report on BEPS. We are going to touch upon what that report contains, so I'm not going to go into it in too much of detail. March 13, again, TP audits got concluded, significant adjustments were made, and in the 12-13 audit cycle, you know, the theme was issue of shares, marketing intangibles, location savings. I think most of you already know what these three topics are, so I'll just take a minute each on each of these topics. Issue of shares is a transaction where an Indian company issues shares to a foreign company. And in this year, the valuation methodology which was mandated by the RBI was the CCI guidelines, and CCI guidelines were then replaced by discounted cash flow from April 1, 2010. So for financial year 9-10, CCI guidelines were in place, and as per RBI, that was the floor value. So that was the minimum that an Indian company was expected to bring into the country when they issued shares. An arm's length price could obviously be higher than the floor. So here, most of the companies that had issued shares, they had obviously used CCI guidelines. So the tax authorities said that CCI guidelines does not result in an arm's length valuation, because it really is, it's an arithmetic mean of net asset value plus profit earning capacity value. So it cannot be taken to be arm's length. So they said the right method to value the shares is using discounted cash flow, and the difference is something that they brought to tax. Here the big issue was that when you issue shares, there is really no income that arises from an international transaction, and how can therefore transfer pricing provisions apply to such a transaction in the first place? So that was the big issue there. The second big issue around this was that having brought the alleged undervaluation to tax as income, the tax authorities then said that since the Indian company has attempted to pass on a benefit to the foreign company, that's in the nature of a deemed loan, so they imputed interest on top of the deemed loan. So the issue around that is that under Indian transfer pricing law, the way it reads, and here I'm not talking about GAR, we'll look at how GAR changes things, but under Indian transfer pricing law, there is really no mechanism to recharacterize, you know, equity into debt. So decharacterizing equity into debt constitutes a secondary adjustment, and under Indian income tax law, those provisions currently do not exist, and therefore the department actually do not have the mandate to do something like that. This issue again traveled to the Bombay High Court in a writ petition by Vodafone and Shell. The Bombay High Court directed the DRP to first deal with the jurisdiction issue, and then the taxpayer has the discretion to come back to the High Court in a writ petition if it chooses so. We have to wait and see how this issue evolves. Marketing intangibles, we talked about the issue of LG, so I'll skip the issue of marketing intangibles. Basically, the department applied LG's rationale into every single case without actually distinguishing between the facts of a licensed manufacturer, which was the case of LG, and the facts of other taxpayers like distributors, for example, where the issue of marketing intangibles is actually relevant. So we'll cover that in the subsequent slide. Location savings was another big adjustment that happened in most cases, and that happened in cases where there was outsourcing to India of services or of manufacturing. So the issue really was that in cases where foreign companies had outsourced provision of services or provision of or undertaking of manufacturing to India, to obviously take benefit of the cost arbitrage, the tax authorities argued that because the cost base in India is low, there is a competitive advantage which is conferred to the foreign company. They save costs, and part of that cost savings under arm's length should belong to India. Now that principle in itself is not wrong, but how the tax authorities went about applying it was completely berserk. The principle here is that even before you look at who should rightfully get to keep the location savings, because yes, every time there is some outsourcing which is done to India, there is a cost saving that is achieved. But the question is that this cost saving may not always result in incremental profit for the foreign company. So even before you start talking about whether this cost saving needs to be shared with India, one has to first figure out that is there really incremental profit that the foreign company has earned? Is there a competitive advantage that has actually been conferred to the foreign company, that which is not available to everybody else? And only if these two tests are crossed, then the question of sharing arises. So to take an example, let's take a look at the pharma industry. The Indian pharma industry is growing to a large extent because of Indian companies offering contract manufacturing services. If you just do a search on Google, you will come up with a list of at least 500 contract manufacturing companies in India. Now in a situation where there is perfect competition in the Indian market and there are so many players who are offering similar services, even if there is a cost saving that arises, under arm's length, an Indian company cannot afford to overcharge its customer. And therefore there would be no possibility of the foreign company ever sharing that cost saving with the Indian company because the market is perfectly competitive. So these are subtle differences, distinctions that the tax authorities did not really apply. They said that they wanted to know what was the cost saving that the foreign company had enjoyed, and in cases where the taxpayers were not able to share that information, they did something arbitrary. In some cases they even attributed 80% of the cost saving to India. And the question really here was that if 80% of the cost saving is attributed to India, then you will see that the contract manufacturer ends up showing much higher profit than the entrepreneur who's sending that work to be done in India in the first place, which is an absurd situation. March 13 also saw 146 AP applications being filed. We talked about it earlier. June 2013, the reporting requirements in Form 3CED were expanded, particularly as a reaction to the expanded definition of international transactions, wherein items like corporate guarantees, issue of shares, etc., all of those things were defined and put into the definition of international transactions itself. So the form was expanded to require taxpayers to report these kind of transactions. The issue here fundamentally remains the same, that while on one hand the form now requires you to report these transactions, the question still remains that is the form really ultra-vires the act itself, because the definition of international transactions cannot create a service when none exists. So for example, in the case of issue of shares, just because the definition of international transactions says that that purchase or sale of marketable securities is a transaction, that does not mean that income arises from that transaction, and therefore that definition cannot override 92(1) itself. 92(1) is the arm's length standard, and 92(1) clearly requires, before TP provisions are applicable, the tax authorities need to show that there is actually income arising from that transaction. So the question of whether this form is ultra-vires the act will still remain, but be as it may, taxpayers are now mandatorily required to report this so that these transactions can be reviewed by the tax authorities in the assessment proceedings. In June 2013, the UNTP manual was also issued, and the UNTP manual had chapter 10 in it, which basically contained chapters on specific countries. So there were 4 countries that were covered as part of that: India, Brazil, China, and South Africa. The UNTP manual clearly said that whatever is contained in those chapters does not reflect the consensus view of the UN subcommittee. Those are views expressed by the respective tax authorities in terms of how they want to administer transfer pricing in their country, but that does not necessarily reflect the view of the UN subcommittee. In this UNTP manual, India has expressed its opinion on various issues. Many of the things that they've said over there represent India's view on those transactions, but not necessarily the OECD view. So for example, in the case of location savings, India has expressed a view that just because the Indian company who is, let's say, operating as a outsourcing company, whether a contract manufacturer or a contract service provider, just because that company is achieving the right amount of margin compared to the comparables, that does not mean that location savings, if at all, is already embedded in the margin of the comparables. Now that again is not the right principle, because if you have chosen your comparables properly, if let's assume that you are an exporter of services and your comparables also constitute significant exporters of services, then any location-specific advantages or premium that that service provider is deriving will be naturally reflected in the margins of the comparable companies. And therefore, if you benchmark such a transaction properly, then it's obvious that nothing further can be paid to India, because whatever further was due is already given. But India has gone ahead and said that that's not the view of the Indian government. Over and above the margin of the comparables, India wants to share in the location savings. There are other, so this was one area where they expressed a very, very strong view. The other area where they expressed a very strong view was in the context of outbound loans, where Indian multinationals who are investing in foreign countries, and for funding those investments, sometimes they take huge loans or which are counter guaranteed by the Indian company, or sometimes the parent company itself grants a loan to a foreign subsidiary. There, India expressed a view that the arm's length rate of interest that India should expect to earn from the overseas subsidiary cannot be linked to LIBOR or MIBOR, LIBOR or Euribor, but it has to be linked to a local reference rate like the prime lending rate. Now this again is a very ridiculous proposition, because if you are lending in the overseas market, you cannot be expected to charge a borrowing rate which is prevalent in India, because the cost of borrowing in India is too high. Just take an example. If an Indian company were to ever lend into the Japanese market, for example, where the prime lending rate is just 1%, will a Japanese company ever agree to pay to India 14%, which is the prime lending rate in India? It just won't happen in real life. But that's the view that they have expressed, which in some form is now also manifested in the safe harbor notification that they've issued, where they've said that when an Indian company gives an outbound loan or there is a guarantee given in favor of a foreign company, the rate has to be linked to a local borrowing rate like the prime lending rate or the SBI PLR. July 2013, OECD issued its action plan on BEPS. So 15 work streams were covered. We'll talk about this a little later, so I'm not getting into it right now. July 2013 also saw the appointment of the new competent authority. So Mr. S.K. Mishra, left his office, and we had a brand new competent authority in the form of Mr. Akhilesh Ranjan. Now that seemed to be a very, very positive thing to happen, and people are hopeful that some of the very tough stands that the previous competent authority took, especially on use of profit splits. The previous competent authority had said that in most cases India would like to apply profit splits, and generally TNMM would not be the right method. So there were very strong observations that had been made earlier. We hope that with the new competent authority coming in, some of these stronger stands which have created a lot of controversy internationally will perhaps look to get revised. There was revised guidance also issued on transfer pricing treatment of R&D centers. And there the big controversy was that when you have a contract R&D service provider in India, what should be the remuneration model for rewarding the contract R&D service provider? The view of the government in some cases was that they felt that significant value was being added here, intellectual property was being developed because of contract R&D, and in some cases the TPOs, they said that the contract R&D service provider should not get a cost plus remuneration, but they should get a share of profit in the product which was commercialized as an outcome of that research. So that was the stand being taken in certain cases, and in this notification the CBDT laid down the correct principles. Those principles were always available internationally. The principle was that whenever you are doing contract R&D, the significant people function is the function of who exercises control. So just because the contract R&D being done in India is very complex or high value added, and it may even involve employment of scientists, That does not automatically mean that the Indian company should get a share in the profit. The critical question here is that who performs significant people functions, and in the context of R&D, those significant people functions are that which is the product to be developed, which is the product to be researched into. That function is typically with the foreign company because they would base that decision on survey of the market, the end target market, because no R&D will start unless somebody has first decided that is this product that we want to develop really has a market. So that function is a crucial function which the foreign company would usually undertake. Once that decision is taken, then the foreign company would then also decide what the R&D budget should be. They would monitor the progress of R&D, and in certain cases where the R&D is not going along the right direction, they can even take the decision to abort the R&D. So these are the control functions, and if these control functions are residing outside of India, then the remuneration model for remunerating an Indian contract R&D service provider should be cost plus. So that's a principle which is internationally accepted, was also endorsed by the security, which was a very welcome sign. In July 2013, OECD issued its action plan on BEPS. We'll cover BEPS again, so I'm not dealing with that here. Just around July 2013 also, the second discussion draft on TP aspects of intangibles was also issued by the OECD. Now that's a parallel project of the OECD, though it has a significant overlap with BEPS, because intangibles is also one of the action points in BEPS. At some stage, OECD says that because the intangibles draft is work in progress, they will converge what they are saying in the intangibles draft with what they will eventually say under BEPS. So that's something that is waiting to happen. August 2013, the Tax Administration Reform Commission was constituted under the leadership of Dr. Parthasarathy Shom. This commission has been given the mandate of studying how India's tax policy has evolved and to make recommendations to the government periodically on whether our tax policy needs to be changed. The objective is to increase the capacity of the Indian tax system. This committee is expected to have, in fact they've already announced the committee, it's expected to have 2 full-time members and 4 part-time members, out of which at least 2 part-time members will be from the private sector. So that's again a good sign. August 2013 also saw a landmark ruling in the case of BMW. Now this was a ruling of the Delhi Tribunal where for the first time since LG, the tribunal actually took a view which was different from LG. So the facts of BMW's case was that BMW was a distributor. They would import passenger cars either in fully developed form or in kit form. And what would happen in India was very limited value addition. So an assembly function was happening here. The car in, the substantial economic value addition was already done outside India, because, just because you're importing the car in a kit form and developing it here doesn't mean that value gets added here. The function that was happening in India was economically a very simple function of assembly. And therefore, for transfer pricing purposes, BMW was positioned as a distributor of cars who adds a little bit of value. So the transfer pricing mechanism was devised in such a way that on the import component, BMW India would get a distribution margin, and on the local value add, which is the assembly function, they would get an additional return on top of the distribution margin, which is how the transaction actually needs to be seen. The department to begin with applied LG Electronics without distinguishing between the facts of LG and the facts of BMW. And in this case, before the tribunal, BMW actually pointed out that when the LG ruling was delivered by the special bench, BMW had actually joined as an intervener, but had later on withdrawn as an intervener because the tribunal was not prepared to deal with the facts of a distributor. Now, if that is what the facts were, then how can LG be automatically applied to BMW without understanding, how does the position of marketing intangibles actually change for a distributor? Now, what this principle actually brought out was that a distributor of goods, for all practical purposes, is akin to a service provider. He is not selling his own goods in the market. He is importing goods which belong to somebody else, and then he is, undertaking marketing and sales, and then selling those goods in the Indian market. And that marketing and sales function is essentially a service function. So if you look at the profile of a distributor, there are two things that the distributor needs to get rewarded for. There is a service element in it, which is the marketing and sales, and there are certain risks that a distributor takes, which are consequent to ownership of inventory. So for example, credit risk, because the title passes